Good morning, everyone, and thanks for joining us. I am Adrian Manz, and I'm going to be going over today sort of my favorite set of indicators. So it's not a bunch of things that are abstract. It's not a proprietary set of things that show me what's going to happen in the markets. This is stuff that you're going to be able to take right from most trading software, and in the process, you're going to be able to gain sort of an institutional view of the world, in a way that's going to make it much, much easier for you to understand the trades that you're trying to get in front of. I've been trading for a very long time. And, my wife, Julie, and I, who some of you know, some of you might not know us, but we've been around this thing for a good long while, and we do a lot of over the years we've done a lot of conferences, we do a lot of television, we do a lot of radio, we've done a lot of just about everything, just sort of spreading the word about what it is that we do in the markets, how it is that we go about trading the markets, and why we got into this business in the first place. So I'll give you sort of the backstory. We were both graduate students out at the Claremont Graduate University in California, and working on, in my case, I was getting an MBA in International Business and Finance and a PhD in Organizational Behavior. And the one thing that I can tell you when you're doing that kind of work is what you're really hungry for is data. And I was super interested in the markets to begin with. Julie and I had started trading together in graduate school. This was back in the mid-1990s. We got married in sort of at the end of our graduate school career, but back in 1997. And, we've just been at this for a long time because we love data-driven events. So we love things that we can go and, just really dig into and figure out what's coming next, why is it coming next, right? What's likely to happen pursuant to what's already happened. And crunching the numbers was very possible because we were working with the folks at the New York Stock Exchange. We had access to markets that at the time seemed unprecedented. It probably was unprecedented. We were able to get down there, work on the floor, get data about how people interact with markets, how professionals interact with markets, most importantly, how non-directional traders interact with markets, because that's really who you're dealing with when you're dealing with a specialist on the floor of the exchange. And what we came to realize was it's all about order flow. So the order flow is the thing that you're compensated for, whether you're trading today or back then. It's, the guys on the floor were $2 brokers, and the guys in the booths were the specialists, and everybody was earning their living, earning their keep by making markets in highly liquid stocks on the exchange. But over the years, what a lot of this has progressed into is it's become very, very dependent on the relationship that you as a trader have with the VWAP. So if you want to make some money, and you're trading for an institution, you're going to have to get on the right side of the volume-weighted average price. And we'll talk about the dynamics of what the VWAP is and how I use it in a minute. But just suffice to say that if you're trading for an institution, let's say a pension fund, and that pension fund sends an order out, and it's to liquidate 1 million shares of a stock, what they're going to want to see is that the liquidation that you achieve on their behalf is at the typical price for the day. You don't want to be way down below where the average price was. You don't want to be way out of line on some of the trades during some time frames and in line on other time frames. You want to be just spot on as much of the day as you possibly can. That's what the volume-weighted average price is about in the professional trading realm, and that is what is going to give you an edge when you're trading in your own account, because you're going to understand what that volume-weighted average price is. Julie and I have done a lot of articles over the year, collaborated on a lot of things. This is just some of the stuff that we've done. We've been in just as many magazines as you could think of, and trading journals, and featured in some books that other folks wrote, like that Breakthrough Strategies of Wall Street Traders. I've also written a bunch of books, and the cornerstone book there, Around the Horn, A Trader's Guide to Consistently Scoring in the Markets. It's out of print right now. I will tell you that my publisher, that was Stillwell and Company, and he's a specialty publisher and been on me to update that book and get a new version out, and we're working on it. So it'll be out there before you know it. If you are overseas, if you are in Europe, in England, or most of Europe, it is Beat the Street. And Beat the Street is going to take that baseball analogy out of the trading. So the trades that I look at, the trades that you hear me talking about in our war room and our trading room every day, that's, when I say things like fastball or infield fly or line drive, switch hitter, all that stuff, that's just a way of looking at the trades through a set of lenses. So we take the statistics back out of it. And, when I first wrote that book, it was called A Multivariate Analysis of Covariance in the United States Equities Markets. And George, my publisher, said, no. You're going to write this around some sort of an analogy. You're going to write this around a metaphor for something that people can understand. And that's where the baseball stuff came from in Germany and in Italy. It is World Cup trading. So depends on where you are. The rest of the world, we sort of took the metaphor thing out, or the analogies out, because we thought enough already. Everything that we do, we teach. I enjoy teaching. People have asked a lot of times, well, if you trade, why do you teach? And I will tell you that it's a luxury that trading affords me, because Julie and I obviously, had gone to graduate school and thought that we were headed for the world of consulting, probably working for McKinsey and Company, and then at some point coming back and teaching in a university. And at some point, Julie said, are we just going to push money around all day, or, are we going to do something with these degrees that we earned? And this is how we do it. So we have a product called the Income Trading Academy, which is a big precursor to going to our boot camp. We have a bunch of trading programs online that are based on different statistical process controls that you can put to work in the markets. And all of them are designed to teach people how to do what we do. It's high-level training. It's the equivalent of you're going off to college, so you're really going to learn something. You're going off to graduate school, you're really going to learn something. It's continuing education for some people. We've had everything from beginners to market makers come to these events. So it's really just hands-on stuff that is designed to make you a successful professional, make you a successful trader. We also host a TV show, and the show is going to be online. So as many of you know, we are from Pacific Palisades, California. Everybody knows what happened there. We had the fires, and we did lose our home. And we were doing a show that was airing from a studio in Hollywood. And as we are now living in Balboa Island down in Newport Beach, California, we're not going to be driving 4 hours round trip to do a show. We are going to be online. And we were just talking to the producers of this. I guess it's going to be a YouTube show. And it's all about the psychology of trading and how you become a successful trader by wrapping your psychology and your strategies and your tactics up in a bundle that makes sense for you and makes it possible for you to trade. Julie and I have developed personality inventories that are, validated personality instruments that will go through and take an assessment of who you are and how your trading relates to the habits of professional traders, of profitable traders. These have been administered to thousands of people at this point, right? It's something that is a deep dive into where things are going to go right for you and where things might not go so right. And it's a precursor to our boot camp usually. It's something that we try to get in front of people and say, let's talk about how we can make things easy for you. Let's talk about how we make this thing called trading a good fit for the person we call you. And when you look at a boot camp, these things they're small. We only have 20 people there. Usually 8 people are alumni and 12 people are new to the program. That's just sort of an average, but we limit it to 20. And as I look around the tables at these events, and the event that we held at the SIBO there, and mostly we do these in Miami Beach, by the way, because we like to head to the East Coast. We like to go someplace warm and beautiful, and the Cadillac Hotel and Beach Club has actually been the home of this thing going on. Oh boy, it's been 11 years now. So actually 12 years at the Cadillac. But it's a really great event. It's a successful event. It's our passion project, and the psychology of all the people in the room is the thing that really fascinates us. We love teaching them how to trade, and we really love working with them to get through the things that are going to make them better traders, and through the things that we need to sort of work out in terms of how they approach the world, how they approach trading, the things that make them nervous, the things that make them confident. Everything is rolled up in who shows up at that event. I mean, I'm looking at it. The fella in the back row there is a food photographer from Chicago. Did wonderful stuff. The guy next to him is a police officer. The guy in front of him owns a limousine company. And I can go right around. There's a fellow who owns a chemical company, or owned a chemical company. There's someone who's in sales. There's an attorney. Now, just imagine for a second that all these guys are bringing a history to what they're trying to accomplish. They've all got something that they're trying to do in the markets, but they also have this background of, I was a successful rancher, a farmer. I've got one guy here who's a farmer who hedged, who did bona fide hedges against crops. That's a very different way of trading. That's a very different thing on the line than coming to the markets every morning and trying to pull $500 or $1,000 out of the first hour of the market. That's what a lot of people are doing. Some people are just content to pull a few $100s out of the markets. Some people are just happy to understand the markets at all. But as you go around these rooms, these are all really great people who we've had the privilege to work with, and who bring their understanding of life and bring their understanding of the markets. And once we're all together, what we're trying to do is get them to see the markets through the lenses that we see the markets through, and then interact with the markets in a way that makes sense. And it's an intensive program. It's 40 to 60 hours, I'm going to say, of online material that they get through, a 700-page workbook they go through before they come to the event, and then it's 4 days live, trading live with us in Miami Beach, and getting to know each other and really working together. And it's just a great event the whole way around. This is it, the Income Trading Bootcamp Coaching Program and Mastermind Group. We're going to be live again in November 2025 in Miami Beach, Florida. You can scan that QR code there, or visit TraderInsight.com/bootcamp 2025, and you'll learn all about it and see if that's something that you might be interested in. With all that said, now let's take a look at my charts and how it is I approach the world of trading, and what my psychology brings to the table when it's time to analyze what's happening in the markets. I don't have candles. I know a lot of you folks love to trade from candles. Julie trades from candles, and that's just to say there is no right, there is no wrong. There just is. It is what is, and it's what makes you comfortable. So I think that I do my best thinking in bars. Probably too much thinking in bars, but in bars on a bar chart. I can figure out what's happening. I see things happening in front of me in a bar chart more easily than I do looking at candles. I've got volume on the x-axis, so volume by time. I draw horizontal support and resistance lines on a chart. I use floor trader pivot lines. I use volume by price analysis, and I use volume weighted average price. That's it. So that's what I've got on screen all day, every day. The boot camp guys, they all trade with us forever, so they're in a Zoom room with us every single day, Tuesday through Friday. We don't trade on Mondays usually. More often than not, Mondays are not a great day to be in the market. There's too much geopolitical stuff goes on over the weekends. And, I think that if you know that Mondays aren't going to be great overall, we know from statistical analysis that it's kind of a push. Mondays at best are a push. Then, why not have a 3-day weekend every week? I think all of these things are pretty self-explanatory, with the exception probably of floor trader pivot lines and the volume weighted average price. So I'm going to go through the charts and just make sure that everybody's on the same page, and then we can do some analysis of how I use these things and how we predict where markets are going to go based on what's right in front of us. So open, high, low, close chart, there it is. Everybody's familiar with this. It's a bar chart, standard bar chart. If you're not familiar with a bar chart because you've been using candles all your life, you can just use candles. But this is what I use. And if you look at the x-axis, you'll see I've got volume that is color-coded by buy-side volume or sell-side volume. And I've got this out here. So this volume by price on the right axis here, this is a histogram that represents an analysis of volume by price. It's not true volume by price. So every one of those bars does not have the exact volume count of what happened in that bar. That's a hierarchical cluster analysis of volume. And what it's really telling us is, at this threshold level, how important was the volume that was going off in the market? So how much impact did that volume have on the directionality of the market immediately after? It's giving us a feel for the order flow. So this is unique to Realtic. I don't know that other software does it this way. They might. If they do, then I would encourage you to take a look at it. In other programs, whether it's Thinkorswim or TradeStation or any of the sort of retail software that's out there, you're going to get volume by price that's a more direct barometer of what happened inside every one of the bars. So you'll see at this price level how much went off. At the next price level, how much went off. Either way, it's useful information. This is just something that when I worked with the folks at Realtic, back in the 1990s, this was a model that I liked because I like statistical analyses. Now, this is second resistance. So this black line is R2. That's a pivot line. The blue line is first resistance. That's R1. The red line is the central pivot. The central pivot is the fulcrum. It's the pivot point that you think the market is literally going to hinge on. It's going to pivot on during the day based on what happened yesterday. If we have an inline open, where do we expect price to oscillate? It's right there at that red line. If price moves through the red line from below and is moving up toward the blue line, then we think the next stop will be the blue line. If it moves up through the blue line and gets up to the black line, we think the black line will be the next stop. So these guys are all very important in our trading because floor trader pivots have been around since before people were using software to monitor the markets. And it's something that you would use to determine the value line, that red line there, for the S&P 500. If you're a pit trader, you would use that red line. You would just always be conscious of the fact of where are we relative to the central pivot. If it gets down to the green line, that's first support. That next black line down is second support. And you can see, you're going to look at charts every day, and if you plot them, these are just going to be included in whatever trading software you use already. If you plot those lines on there, you're going to see that on most days, price action is very, very respectful of those pivots. It's not frequently the case that we blow out in either direction. As a matter of fact, if we're beyond S2, the bottom black line here, or R2 on, say, the triple Qs or the NQ, then from our trading, what we know is you've got a 77% probability from second resistance that you're going to move back down towards first resistance, and from second support that you're going to move back up to first support. So they're again a statistical tool that you can use to interact with the market. It gives you a real good understanding of where price is likely to be. This orange line is the volume weighted average price. So now we've got two things that I'm not sure everybody is aware of the calculation of here. Volume weighted average price and those pivot lines. So the first thing I want to do is just go through and get these calculations into your head, because I don't think it's a good idea ever to plot something on a chart and just see a bunch of squiggly lines or straight lines. I think you need to know what the thing is that you're looking at so that you can evaluate what it's telling you. I cannot tell you how many times I've had people who put stochastics or an RSI or something on a chart, and sometimes you almost can't see the chart from all the analysis that's going on. You can't even find the bars in there. And then if I ask them, well, what's that stochastic telling you? How many periods is it? How many? Well, I don't know. I just plot it because it gives me an indication of overbought or oversold. Stochastics weren't even written to give people an idea of overbought or oversold. That's not what the purpose of the thing is. So I think, no matter how you wind up using something, understanding what it is to begin with is very, very important in becoming proficient at what you're doing. Floor trader pivots, the 5 pivot lines that I've got plotted on a chart, this is all they amount to. So the red line, the central pivot, that is equal to yesterday's high plus low plus close divided by 3. So a pivot line is giving you a typical price. That's the definition that would be best applied to what is the pivot line, what's the central pivot. It's the fulcrum. It is based on yesterday's typical price, and really what it's giving you is an idea of where the perceived value is going to be for today's session. R1, the blue line on my charts, is just 2 times the value of that central pivot minus yesterday's low. The green line, S1, this can be the one that's underneath the red line, or it's down below the central pivot. S1 equals 2 times the pivot minus yesterday's high. And then R2 is the pivot plus the quantity R1 minus S1, and the black line down below, second support, is the pivot line minus the quantity R1 minus S1. So those lines give you the value zone. And just one more aside here, if you open and you gap higher, so let's say you gap up to the blue line and you're oscillating around there, things shift, and what you begin to assume is the blue line is going to be the central pivot for the day. If it gaps up to the black line, same thing. If it gaps down to the green line, same thing. So as it violates pivot thresholds, we start to look at price as it relates to those new levels, as it relates to R2, S2, R1, S1. Once it gets up there and starts working around those threshold levels, then we're looking at those and saying, well, those are now acting in the capacity of the central pivot. Now we've got our volume weighted average price. And volume weighted average price, the way this is computed is confusing to people. And I think this is probably the best way that I've been able to explain it. You need to first create a typical price for whatever time frame you're looking at. So let's say you're looking at 5-minute bars. If you're computing in a 5-minute bar a volume weighted average price, the first thing you need to know is the typical price, and it's the same calculation as the central pivot. It's the high plus the low plus the close divided by 3. So you're always taking that current bar and saying high, low, close divided by 3, and that's going to give you the typical. So if at 9:30 the typical price was $99, and at 9:35 it was $100, and at 9:40 it was $101, then you need to know the volume. The volume for each one of those time periods, to calculate the volume weighted average price, you're taking the sum of the periods that you have. So at 9:35, you're going to take 9:30, you're going to take 9:35. You take the sum of the typical price times the volume divided by the sum of the volume. That gives you that orange line. So it's like a moving average in a way, except that it's giving you a moving average that's factoring volume into the equation and letting you know where market makers, other participants in the markets, are very likely going to be focusing their energy. Where are they going to try to keep price? Because it's not necessarily true that if I've got 1 million shares of Micron that I need to move today, that you're going to see me coming. Because if they're handing me 1 million shares of Micron as a sell-side order, they have probably handed someone else 250,000 shares of Micron as a buy-side order, because the game is to try to push price back toward the VWAP. Remember, you're getting compensated for where your trades are in relation to the volume-weighted average price if you're an institutional trader. If you're trading on behalf of an institution, you've got to come in close to that line. What are you going to do if price starts getting away from you? Well, you want to have another desk, and that trade desk is responsible for pushing price back toward the volume-weighted average price. The way they do this is they issue sell orders. If I'm your buyer and I see that I'm getting away from the VWAP, I take my hands off the buy button for a while, and then someone else out there is selling back down toward the VWAP and pushing price in for me, and that's where I come back in and start accumulating again. The best way to get your psychology aligned with the market is to understand how the market works in the first place, so that you can operate in the same way that the market makers who are out there pushing and pulling price around are. You're not interested in beating the market. You're interested in understanding and cooperating with the market. So let's take a look at a couple examples here. Let's look at the Magnificent Seven and see what happens over the course of the day as the volume-weighted average price moves away from us, moves back in our direction, and moves in conjunction with price. Where can we, as intraday traders, go and find profitability? All right, so let's just run through this with a few of my favorite stocks. Here we have Apple, and you can see that I've got a plot here of the floor trader pivot lines. The red line is the central pivot, blue line is first resistance, black line is second resistance, green line is first support. And Apple made a big move right off the opening bell. And if we go and start picking this apart, the first thing that I generally like to do is draw some trend lines. So let's see where we think we're finding natural support and resistance. You can see here, these wrap up nicely with the volume by price data over on the right side of the chart here. And those pivot lines, this second resistance is starting to act as a support. Now let's look at where some opportunities might have existed based on trend moves. You can see that by drawing an anchored VWAP from this trough to this peak, across this time right here, we've got an anchored VWAP at 214.06. And when price came back down there and hit that level, we had a ricochet that got us right back up into 214.72. So nice opportunity for a profit here, and that's after our opening trade was in place. Right now, anchored VWAP from this point in time to this point in time is right here at this volume by price. So once this low was in and this trend lower had started here, we had the opportunity for a move back down to the pivot when we hit this anchored volume weighted average price. Here's another example. This is Amazon. Same thing, we can go through and start trying to isolate where we think these volume by price clusters happen to overlap with some natural support resistance, some natural order flow areas. Then go and get our anchored volume weighted average price in place. So see that on this move higher, VWAP overlaps with the session VWAP. That's to be expected because the session was just underway there. Gives me the confidence to say that if price comes back down through, tags this volume weighted average price, moves higher through this 227.70 level, that then I'm interested in picking it up and looking for a first target up here at 228.13. Got a nice trending day on all of our Magnificent Seven stocks so far. You can see that right around 11:30 in the morning is where I like to set these up. This is where I usually do my broadcast and talk to everybody about the game plan for the afternoon. Here once again, we see that the volume weighted average price, natural support and resistance, and volume buy price are overlapping and giving us confluence. So in this case, a 189.84 entry, retracement to the VWAP is a good place to get long with a 190.35 first target. Meta. This one's too rich for some people's tastes. I like trading it. See again, getting a nice just confluence between natural support and resistance, volume by price. Everything just overlaps really nicely. And in this case, once again, the anchored VWAP isn't going to tell us a whole lot yet, except see that right at our pivot line, we've got the anchor for that morning swing. And right now, once again, right at the pivot line, we've got confluence. And what that tells me is that since price has broken down through the volume weighted average price, and it overlaps with the pivot line, which we know is a natural inflection, and we know that we're at second resistance, which is a little bit of an extension in price. At 713.27 is a good place to put a short sale entry with a 711.82 target. Right now we've had one trade here that is working out in our favor on Meta. Here's Microsoft. It's oscillating around the central pivot. So this is in a confluence zone all of its own because we're in Friday's price action. And we see that we've got thresholds that are overlapping and giving us some interesting trading ideas. So notably, since we're still up in the top of the range here and right on top of the support and resistance area, it's 510.15 pinch, squeeze between natural support and resistance and the central pivot, again makes for a good trading opportunity. Now let's take a look at NVIDIA. See here that this one's also right around the fulcrum. It's right around that central pivot. But that we've got a lot of sort of choppy swings going on. And if I'm looking at anything, it's 172.49 for an inflection move higher through that volume weighted average price. And then we need to get through the central pivot to get up to that 172.77 target. So at this point, what my lines are telling me is really that I don't have a big opportunity here and that I should probably wait for this stock to settle in and trade through the rest of the session. And finally, here's Tesla. Let's just do the same exercise. It's trading around fulcrum. It's right around the central pivot. Let's give ourselves some inflection levels to look at. And we can see what happens over the course of the session. And that is really my first markup of the day. So this is how we just start putting things together. If you guys tune in, if you sign up for the free text alerts, you get a text message from me just about every trading day, Tuesday through Friday, saying I'm about to go live with a video, and then I start picking these apart and looking for opportunities. Right now, we're looking for a Tesla inflection at the volume weighted average price, and as long as we're trading below the VWAP, we're going to look for a 330.16 entry. And one of the first places we would look to target would probably be not all that far away, down here at this anchored VWAP at 329.39. So as the day goes on, what we see is price settles in. In some cases, like an Apple, settles down too much to be tradable, or a very tight range here on Apple. Amazon is opening up a little bit, and what I want to do here is add more trough to peak VWAP lines so that I can see where I think value lines are. So for this case, a move back down to 228.13 would run right into that anchored VWAP. I would probably take that first inflection based on the fact that it's also overlapping with the price values, or the volume by price cluster analysis here on the right axis. I would take an entry at 228.13 and look for a move up to 228.59. Not looking to short this stock because persistence of the trend and the fact that it's trading above its volume weighted average price for the session. Google's in a sideways range, and again, we just want to go mark these trough to peak moves. In this case, I would say if Google makes a move down to the volume weighted average price, retests the elasticity, moves below it, comes back up again, I would enter a 189.84 violation and look for that 190.35 threshold to be sort of the upper boundary. Meta, if it's trading down below that 713.27 pivot, which overlaps perfectly with the session VWAP, I would look for a move from 711.82 up to 713.27 based on another retest below this horizontal line, and on a move up through the pivot line, what I am expecting is to see a move from 713.27 up to 715.59. It's going to keep it contained here in all this volume by price data. Thought process on Microsoft for the session was long at 510.15, so right above this VWAP, and at this support, stop loss would be down somewhere 509.60-ish, and target, first target 510.70, and the next target, just based on everything that we see going on here, 511.82. NVIDIA is making some big swing moves on the session. Again, if we go trough to peak, or peak to trough rather, we see that this area that we're inflecting in right now, below the volume weighted average price, is where we would expect to see some resistance based on what happened on the move lower. We've got a couple more areas of support on the way down. They line up nicely with yesterday's support and resistance. And if we get up into 172.49 and stay above there, then a move up above that red pivot line at 172.64 would make for a 173.03 targeted move. So look for a move, continue above the pivot from 172.49 up to 173.03 if we get through that pivot line. And finally here on Tesla, let's see, this trough, or this peak to trough move overlaps at 328.42. And we're trading below the volume weighted average price on the session. We're still above the central pivot, but we're in a bit of a downtrend for the day. 330.16 seems to be an upper boundary. I'd probably use that as a stop. but that volume weighted average price there, just shy of that, to my eye, is a good place to short the stock. It's from about 329.90, and our target here is going to be just above that 328.42 natural support and resistance. I'm going to try to put the target just above that volume weighted average price that's anchored right on top of that line. I apologize for the glitches in the audio here. We are on the road and have been doing this live from some laptops and stuff, and the laptop is going to be replaced here tomorrow. We've got a little problem. If you'd like to join us and see how these things carry out in real time, see what happens, how these trades are put on, and you can scan that QR code there, or just go to TraderInsight.com/live-stream, and you have to enter your phone number, a text phone number, and your name and your email address. And what you get then is every day before I go live, you'll get an email and a text that says the live stream is about to start. The text message is the most efficient, and you can join us, log in, see it on your phone, go in there, trade the markets, and follow along with what we're doing. All right, so I hope that you found this helpful, and I will see all of you next time.